inventory situation, and we've been pointing at that inventory situation for a long time. And as Doug said very clearly in the previous panel, that when you take from your inventories in the consuming areas, you don't need shipping. And now the inventories are down where we expected them to be, around the 5-year average and even lower. So now everything points in the right direction, but it has not happened yet. We haven't had that extra oil yet. We're still waiting for the point to make it to turn, and that is more oil from OPEC, which in turn will produce more products, arbitrage, and everything is let loose.
What about you, Marco? You've been on this panel for quite some time. Are you surprised to see the rates hovering where they are currently?
Well, I think you forgot that I've been wrong for quite some time. I've seen this market improving a long time ago. Look, I understand what Kim says, but I think it's just frustrating for us, like for people who are investing in our companies, the fact that, you think you have found an area of problems. Kim was correct. The inventory, they spotted it, we discussed about it, he was totally right. But then the inventory has dropped. Then you're thinking about, but it's the price of oil. And then the price of oil is back to 80. Then you see there is the big ships that are taking cargoes on the maiden voyage from Korea to Europe, and that's also going to change. So it's always been, I think, we've always tried to justify something that we have not been able to understand. So I agree with what Kim says, but sometimes you also wonder, is there something out there that we do not see, and then in 3-4 years, or when the market will change in 6 months, we'll be saying, oh, we should have figured that one out. I'm always afraid that the market is always trying to self-justify itself. And, we do these discussions very often, and I think there is a lot of factors, but for sure, all the factors positive are there, pointing in the right direction. It's just that, there was no positive feedback to all of these arrows pointing up. Just in the best case, they were going laterally, if not going down.
Fair enough. And maybe sticking to kind of recent events, the US-China relationship has surely been affecting expectations on shipping market, I guess, especially on containers and LNG. But Eddie, what would you think the applications would be from a full-blown trade war on kind of the product side?
I don't see any implications for the product tanker sector at this stage. If this is a full-blown war, which will go down further down the line, it will affect everybody, and I guess it will affect the tanker market as well. Let's not forget that the world economy is growing by, according to IMF, by 3.9%. So we have a good growth, good fundamentals, and so far I don't think the market is affected by this trade war between the US and China. In any case, I don't see any trade for products, substantial trading between the two countries.
Mm. And what about Christian, the recent, sell-off in emerging markets? Some of these countries have been, inflating drivers of imports, Brazil, Mexico. Are there any, implications from that market?
I read the stories about Brazil and Mexico, and I don't think that really is the explanation of the weak market. If we look at it, compare first half of 17 to second half of first half of 18, then we actually see traded volumes are up by 6%. What we also see is that their transport is shorter, so that cuts off maybe 2 percentage points of the growth. And at the same time, we also have the cannibalization from the crude market coming in, cutting off maybe 1% of the demand growth. So I think that's where the real explanation is. You will always have various countries that are in difficulties, but individually they will not make the story here.
Yeah. I guess speaking of the crude market, the crude and product in many ways have many of the same demand drivers, whether that be economic growth, oil consumption growth, refinery additions and changes in refinery runs. But as some of you also alluded to, you have the switching effect created by the LRs, switching from CPP to dirty and the other way around, depending on market sentiment. You also have the cannibalizing of crude new builds, traditionally, taking LR trades in the East. How important is the crude market for the product market, Kim?
It's very important. It's the same market. We all need oil, and oil is products in the end. It starts with crude oil, but we're not putting crude oil in our airplanes. So they're very linked, and there could be lagging times in between when one is taking off and the other one is lagging. But overall, they certainly work very closely together. There's no doubt about that. So there are temporary disconnects every now and then, but the big crude tankers taking the big slugs on their maiden voyage, I'm so used to it, so I don't, it is what it is, and it will be like that until the oil company says we're not putting products in a crude tanker, and which they won't. So that's that situation, of course, and the switching is a factor. The switching is a factor. It would delay one segment from another when they switch from clean to crude and vice versa. And there was a figure about all the LR2s switching from clean to crude in 2015 when both markets were out. That catered for something like 85 MRs in loading capacity that particular year. So it has an impact. But they work together and they are in tandem, and oil is our business.
So Morgan, I mean, is it possible to kind of quantify the impact of potential switching? I mean, you have 330 LR2s, you have 380 LR1s, and roughly 600 MRs. How many of them do you think are trading dirty these days?
I think probably the bigger part of the fleet trading dirty is on the LR2 and LR1. And Mars, I don't think you see a lot of switching. At least we tend. A lot of our customers want to keep them clean. So we don't see a lot of switching. I think you see it more on the bigger size. But then when one LR2 goes clean or goes dirty, it is a big factor because it takes out a lot of MRs. So at the end of the day, but also the other interesting thing is that we talk about MRs. If you look at this market, at the end of the day, the MR has been the most resilient segment of the fleet. It's the one with best performance, considering the different price ratio of price to charter ratio. MRs have been the best performing ships in this period, and it's kind of amazing how this ship has really became so intertwined in the trade business. It is really proven to be the workhorse of the trade. So MRs have been doing. Considering the sad general state of the whole market, MRs have been doing pretty well, have been outperforming. Ships that have been costing 10, 20, 30% more, they've been doing pretty well.
Yeah, that's true. Christian, you also have some LRs. I mean, there's quite a heavy delivery schedules on crude, has been in 17 and 18. You're churning out more than 50 VLs and Suezmaxes, and next year also quite a few of crude VLCCs. I mean, is the product market to turn, even though there's a delivery schedule still on the crude market?
So I think there's a link between the markets, and there will be some kind of time delay between it. And just back to the point around the cleaning up of LRs, we have seen over the last 10 years, we've seen the range of LR2s that are in dirty somewhere between 32% to 45%. And right now, according to our figures, we're at 37%. So we are in the middle of the range, and it's normal what we're seeing here. But it gives headwind in the short term, and of course the crude market is also giving some headwind at the moment.
Right, and maybe sticking with you, Christian, I'd just like to get kind of the high-level view from each of you, maybe where you guys concur and maybe where you disagree on kind of the path forward. I mean, is there a silver lining to all this?
I definitely think that we are seeing some good perspectives in the product tanker market. The supply, we haven't talked much about it, but the order book is well managed. It's just around 10% and coming at a good schedule. Demand is fundamentally strong. We are seeing the product tanker story playing out. If we look at refineries being added in the Middle East, it's the same for the last 5 years. It's going to be the same for the next 5 years, plus 30%, so it's actually picking up in speed. We haven't touched upon it yet, but IMO 2020 is going to be a catalyst for the market because we are going to see some inefficiencies in the system. So I definitely think that we are looking into a stronger market, and we have also positioned ourselves for that. So we've been investing in TORM, spending about $350 million on new vessels over the last 12 months. So we definitely think there's a silver lining in the market. Mm.
Maybe Eddie, I mean, I guess the MR order book is less than 10%, but 10% is not a very small order book if you kind of spread it on 3 years. It's 3-4% gross. Do you think it's sufficiently low to kind of help?
The order book. Yeah, we estimate the order book to be around 6.8% for the next couple of years, which annualizes about 3.4%. This is excluding slippage and scrapping. So it's, I think it's the lowest order book we've seen since the year 2000. So it's a good sign, considering also what Christian mentioned about 2020, and considering also that about 7% of the fleet, of the MR fleet today, is around 18 years of age plus. So we think by 2020 we will see increased scrapping also in the MRs. Considering also they will have to go through the fourth special survey, install the ballast water treatment system, plus the consumption issue, because as we know, only 1% of the MRs will be installing scrubbers. Therefore, the vast majority of the MRs will be switching to marine gas oil or whatever blend is out there by then. So we're very positive on the MR.
What about you, Mark? I mean, you said you were wrong before. Have you changed your thesis?
No, I think if you insist in one position, and then you'll be right, you know. So that's why, you know. So why change at this point? Risk of being wrong, you know. What I would like also to add to what Eddie was saying, what is also very, very puzzling in all of this is that a lot of prices of new buildings have not been going down. Price of new buildings have been going up. So you find a situation where price of new buildings are going up, but charter rates are at a very low level. So this is also two things that tend to be a little bit in opposite direction. I think I'm still very positive. It's very frustrating. You know, you would imagine that then you have a good quarter and this and that, and then it's postponed and postponed and postponed. It's like, you know, it's always waiting for something to happen which is not happening. So it's frustrating for us in the business. It's frustrating for investors who are investing in us, for our shareholders. I think there is a certain amount of frustration here about all of this, and I totally understand it.
Mm. What about inventory scheme? I know that's something close to your heart. I mean, in the US, which is the most updated one, I mean, distilleries are now quite low, but though gasoline stocks are more in the high range. I mean, when do you think we're actually to see an inventory build again? Is it going to be this year, next year?
First of all, we have to have a stop in the draw. And that's when the market's going to change, when we stop taking from the inventories and more oil on the market, so we get it stable and possibly up. And I think that's going to happen during this winter. And I'm not disagreeing with anyone. And all these arguments are good, and we're not going to have different opinions on the path going forward. We're all optimistic. And on the demand side, I have to say, we've been going from 40 million barrels a day to 100 million barrels a day in 40 years. I mean, demand is not our issue. It is the supply side that we're crashing ourselves on a regular basis. You're correct in saying that the order book, and that's the expression these days, the order book is low. Yeah, it's lower than it was, but it was extremely high. So what is low? And I was talking to a shareholder the other day, and he called, and I was using the argument that, hey, the net growth of the fleet is very low. It's only maybe 2%. And he said, holy smoke, you should have negative growth for once. You never had a negative growth. And that's really what we need every now and then, a real, you know, take everybody to the cleaners and stop ordering and have a negative growth for a while. So you're right, 1 to 3% net growth is not a heck of it's not very little, it is not.
Mm.
But one thing that is not very little, but on the other hand, I think what is also compounding this problem of the number of the percentage is that we've been in the years, efficiency in shipyards has been growing so fast. Before you had a cycle of 18 months to finish one ship, admitting there was nothing else. Now we're to 11 months. So I think that all these cycles have been accelerated dramatically because supply can come in the market much faster and much more aggressively than it used to come before. So I think it's very self-defeating. Then you talk about the people who order ships, of all our colleagues, and you say, but why did you order? Well, if I didn't do it, somebody else would have done it. And so this is the whole argument. So, you know, it's kind of getting, I think there's a certain degree of willing to inflict ourselves wounds, I think, in the industry on our side. So, but...
Kirsten, you alluded to kind of the ramp up of refinery capacity. I guess, you know, from 11 to 16, there was a significant increase in capacity in the Middle East, and which proved very beneficial for larger ships in 14 and 15. I guess, you know, a similar increase can be expected from 18 to 23. So is that kind of something that can help the product market, say, in 19 and 20?
Yeah, definitely. This will be export-driven capacity coming from the Middle East. I mean, driven mainly by naphtha exports, which has been the leading product this year, the past years. Overall, yeah, it's a good indication of new refining capacity coming in the market, which will help the product tanker market, as well as the Chinese new refiners that are coming into the market in the next years, which are export-driven. So overall, it's a good capacity coming in the market in the next years. We estimate it to be added capacity of 7.7 million barrels per day in the next until 2023. Yeah.
Christian, just finally on this topic, I guess the Chinese refinery additions, kind of on a net effect. I mean, what do you think? It's positive or negative for?
That is a difficult story around China because in a product tanker context, it hasn't really played a big role historically. You are adding larger refineries that can export instead of teapot refineries, but it's going to be quota-based. So hence it's going to be policy-driven, and how that is going to play out is just very difficult to predict. But right now, it's not a big story.
Mm. And I guess we need to touch upon IMO 2020 as well. I mean, for tankers, we think this is the biggest thing since the outphasing of single hulls. And I guess for product, there's an even more appealing story to this. So I guess for each of you, I mean, how have you kind of, allocated your resources and your fleets and whatnot ahead of this implementation? Maybe start with you, Kim.
Yeah, first of all, we think it's going to be good. All the refineries in the West are old and old-fashioned and produce a lot of heavy fuel oil that is likely to be shipped to the more modern refineries in the East and being cleaned up and to produce compliant fuel. And lots of that is going to go back to the West, which is good. So from that perspective, yep, there is going to be increased transportation need for products 2020. Then how we have prepared ourselves, everybody, it's almost, written on the wall that fuel oil prices will go down and MGO prices will go up for the obvious reasons. So we have taken positions on that in the derivatives market. So we're prepared. So we're taking a good chunk or a comfortable position on our bunker exposure in 2020, 2021 on that spread. And hedged that. And that is, we'd started that already a year and a half ago, and certainly it's moving in the right direction, so that's good.
And Marco, you have quite a few new builds from 14 to 18, but to my knowledge so far, and not any scrubber.
We have actually to be delivered, we still have 2 LR1s. Will be delivered at the beginning of next year, so one will have a scrubber and the other one also. That was the story on the scrubber side. Personally, I think that the 1% of MRs not having scrubbers, I think that's kind of an accurate figure. And I think on the MR trade, this is going to be, I think the market is also going to improve in general, also because there's going to be a lot of slow steaming. If bunker becomes more expensive, what are you going to do? You're going to do slow steaming. So then you'll be improving ton miles dramatically very quickly. Another thing that I think not a lot of people have been focusing is going to be a little bit of revolution on the products. But it's also going to have a huge impact on the crude. And here I have colleagues who are much more expert than I am. Because if you start with a crude that's much sweeter than one that's sour, that has more sulfur content, so the refinery can produce low sulfur fuel at a cheaper because the feedstock is already lower. So I think there's going to be also a big revolution there, a big change in pattern of trade of which crude is coming from to which refinery. So also that's going to have a big impact. I think when you have all these changes and you have a lot of uncertainty and you have a lot of loss of efficiency, that's where shipping, I think, tends to thrive, because the biggest enemy of shipping is the efficiency, the speed. When you have all these problems, I think that's the moment when shipping will be doing okay. So for these reasons, I think that 2020 will be a positive year, I think.
Eddie, switching 2.5 or so million barrels of HFO to compliant fuel, suggesting a lot of incremental shipping demand. Is that kind of a way of thinking about the product trade?
Yeah, definitely. It's very interesting. The majority of which we believe will be carried in the Mars. We've also see the trend reactivation of older refineries with a task to desulfurize high sulfur fuel oil. And this is something new which is happening in the market. Therefore, we expect ton-mile demand to grow substantially for product tankers. It's a good development overall. As Marco mentioned about slow steaming, it's very important. And slow steaming, we estimate that will take approximately 50 MRs out of the market. So overall, yeah, it's a good development, and we're very positive about the prospects of that.
And Christian, you actually opted for scrubbers. Mm-hmm. One of you actually quite on the product side. I mean, can you walk us through the process that you guys did ahead of this?
Yeah, certainly. We've been spending maybe the last year and a half debating the topic internally around scrubbers and not. And a year ago, we made the decision to make the first scrubber installment on a new building, an LR2 that was delivered to us here a few weeks back. So we have a test case with that. It's Alfa Laval, where we are getting the first experience on that. We have also this week actually installed a scrubber on a retrofit vessel, so retrofitting an existing vessel, and it's getting some experience on that. I think the business case, if you believe in a spread of, let's just say, $200 per ton, and an MR on average uses 15 tons per day over the year, it's about $3,000 per day, or about 1.1 million a year per vessel. And you have to pay $2 million for a scrubber, then the case is pretty good, even with conservative assumptions. So in TORM, we think it's a positive thing, and the easier decision is, of course, to install it on the vessels that are new buildings, because they are ready for it, and you don't have additional off-hire. How many we'll do of the retrofit vessels will, depending on the experience we are getting now from the vessel that we have on water, and we're testing at the moment. But I do expect more to come.
Kim, you had something to add?
Yeah, I just wanted to clarify our position. I mean, we're taking the derivatives, and we're fine with that, and that's doing great. And in the meantime, our main focus is not to do scrubbers. So we're one of the few that actually stick out our neck and not doing it. And I'm speaking for Concordia Maritime. Of course, the bigger group, Stena, has done it on their ferries and their ro-ro ships way back when. So, but we believe that with that paper position and the fact that there will be compliant fuels come 2020, and there is a big question mark in our mind whether there will be HFO enough come 2022, 2023, when the scrubbers are paid down. So therefore, our mainstay or our current trade is not scrubber.
Can I add to this? We are also of the view that we are not installing scrubbers. It's a very costly exercise. For an MR, a retrofit today, it's in the region of 2.5 million, depending on the shipyard. For small-sized vessels, medium-sized vessels, with eco characteristics, it doesn't make sense to install scrubbers. This is our, I strongly agree with Kim that the new blends that will become by next year will make sense and will be at a lower cost.
It's always easy and comfortable to be in the majority. Yeah, we think the same way here. So
then I can differ on that. Honestly, I've had difficulties finding any oil analyst that say there will be any shortage of high sulfur fuel oil in the next 5 to 10 years. And the price spread, that's always anybody's best guess. I do think the business case is quite good. So I struggle a little bit to see the arguments for why not going scrubber way.
I guess another argument against is, the MRs cater for a lot of the smaller ports. Is there a risk of not having, the HFO available? I mean, in your spreadsheets, you assume that they actually run on MGO for some of the time at sea? Yeah? Yeah.
Okay. And, then I understand also the point of TORM. The thing that in all calculations we say, the calculations are all very right. But then the unknown factor is the spread between high sulfur and low sulfur fuel, and the second big factor is for how long there's going to be that spread. If it's going to be for 1 year, it's one story. If it's going to be for 5, it's totally different story. And I think that the market normally tend to adjust themselves pretty fast. So I don't know, probably anyhow, it's a guess. So.
All right, and I guess nobody is ordering vessels given where the market is today, but at least in Fearnley, we're quite optimistic for 19 and 20, and certainly there will be discussions about new build orders again. I guess for product, there seems to be a great reduction in yard capacity. I mean, the Japanese is not building a lot of product tankers, and in Korea you had SPP close, you have STS has been restructured, and Korean yards in the past, they used to deliver 100 plus vessels each year on the products. And I mean, what's the capacity for product tankers in Korea these days?
From what we understand, in Korea we have, besides Hyundai Mipo, which is the most active shipyard, which can produce today 20 to 30 vessels per year, plus their affiliated shipyard at Vietnam, another 10 to 12 vessels. We have STX, but we know what's going on with STX with the refund guarantees, but they can also produce 10 to 12 vessels per year. And we have a smaller shipyard called Daisan, which can build another 5 to 6 vessels. So overall, you could say the Korean capacity today, it's around 50 to 55 vessels.
Mm.
And the Japanese, it's very limited, and then also in addition of being very limited, they're kind of full. I came back from Japan yesterday. They're very full, and in addition to that, Japanese shipyards are very expensive to make MRs. And MR in Japan, we're talking over 40 million. So there's a spread, a differential of 4 or 5 million between a Korean MR and a Japanese built MR. So it's kind of difficult to see how that's they'll be doing some more dry cargo ships or things like that. I don't see them building MRs.
Mm. And I guess on that note, I mean, 37 million for a Korean MR. I mean, the VLCCs and also Suezmax newbuild prices has been increasing more than 10%. It seems some products less so. So, Marco, do you think are the Korean making money on products these days?
I think they're very much borderline. Telling you about Japan, I think this week or next week, all the shipyards are renegotiating all the steel contracts. One of the big factors of bringing inflation on price of ships has been the steel prices, steel plate going up. And that's going to be a big issue for the Korean yards. They face the same issue, so I think there's a lot of price pressure. I think probably the Koreans, the Vietnamese are a little bit cheaper, but everybody faces them. I think that below 35, 40, 34, 35 million is tough to go below those numbers. I think, and also because you can do it, but then you're locking in a loss, which today the banks who are issuing the refundment guarantees are not willing to lock in a loss for those shipyards for not being in a situation like STX and all the shipyards like that. The problem of STX didn't come from the shipyard with the price, was the banks issuing refundment guarantees not willing to help a client in difficulty to consolidate a loss. So I think we're there price-wise pretty close.
I guess as a final point, I mean, surprisingly, there's actually a lot of M&A talk now in product tankers. You have the, Diamond S fleet is said to be for sale. You have the pending merger of Hafnia and BW. You have TORM's listing in the US. So, I mean, Eddie, you think the market is big enough for more listed product names?
Not really. I think we have enough product tanker names. I mean, capital markets are not there. So we have to find more innovative ways to grow our companies. The companies you mentioned also have investors which are looking for a way out, and they're looking for an exit, and therefore it makes sense for them to have a visible exit event. So overall, I think it's a good idea to be joining forces in this market. We are of the strong belief that the market will be good in the next 2 to 3 years, therefore, and it will be a sustainable recovery. Therefore, it makes sense to join forces with other companies.
And Christian, what's the ambition of TORM's listing in the US, do you think, going forward? What's the ambition? I mean, what's the end game?
So let's see, we took the first step with a listing in December last year. We'll probably follow up with a shelf registration at a point, and let's see when the market is there, that can be some activity.
Mm. So final question is for all of you, I guess, as the product names, at least on our numbers, trade with a very significant discount to steel. Kim, how do you think how should we gonna go about this, getting it up?
We need long-term profitability.
What about you, Mark? I mean, on the 2Q earnings, you said that the discount was around 40%, which seems to be the highest in
Yeah, for sure.
a lot of years.
We have this discount that comes a little bit also from where we're listed, but I totally agree with Kim. We have to deliver results. So, unless the price of shares is nothing else than the discounted cash flow of the value that you expect and dividends to be distributed. So when you don't distribute dividends and the value of the shares are not going up, I don't see how you can improve your discount to steel. So I think we have to give some performance.
Right.
Or the market help us, it's not us.
What do you think, Eddie? Does size matter in this market? I mean, or is this just kind of the pool sufficient enough to provide the?
Yeah, well, size matters, yes. I mean, it creates economies for the company. On the other hand, commercially, it doesn't really matter because you can, even a small owner can place a vessel in a pool, and commercial pool, and therefore have all the benefits of the market. Therefore, commercially, it doesn't make sense. But operationally, yes, size matters. I think you achieve economies, and it makes sense to have a bigger company. It's a bigger player, and you get all the benefits of a bigger company.
Perfect.
At least if I can add here, I think the economies of scale are mostly on the capital markets, both vis-a-vis the banks, but also vis-a-vis the shareholders. And that's where you really get the benefit from having a larger platform.
Then I thank the panelists for joining.
Zero.
And, thank
We
you.
just saved ourselves.